In today's video, we'll break down the 4 different stages of volatility on FOMC days. Now, this is derived from manual research going all the way back to 2019, in which we've been tracking what tends to happen with regards to volatility on days where we have pre-scheduled Fed events, things like the FOMC minutes. Now, let's dive into the 4 stages first, and then I'll leave you with a link in case you'd like to apply those 4 stages on previous FOMC days. Now, stage number 1 I found is the build-up stage. This is leading up to the actual announcement. We have a build-up with volatility, and we'll take a look at what today looked like. Then we move on to stage 2, in which we have our initial FOMC reaction. This is typically right when 11 a.m. Pacific hits. We see the large spike up, and we're tracking that initial reaction as one clue in this series of clues to try and determine what is likely to happen next. Now, stage 3 is where I think you have a level of predictability where we have a fade of the initial reaction. So if, say, the initial reaction was up, then we have a fade where we have a short side setup. Similarly, if our initial reaction was on the short side, then we have a fade where we're looking for a long setup. And finally, we have stage 4, which is the aftermath, and this is after the entire hour has passed. We see on a relative basis the volatility starts to contract. However, if you were to compare the volatility during the aftermath and the build-up phase, you would notice stage 4 has dramatically more volatility in comparison to the build-up phase. And we'll take a look at how all 4 of these stages fared in today's volatility with the major index markets. Now, for those of you that enjoy the research aspect of this, you can also review past FOMC days and repeat the same model, all 4 stages, to see which stages have triggered previously in the past, where have we deviated from this model, by going to our URL, tosindicators.com/tag/FOMC, and there you can find previous trade reports, which in many times contain live recordings as well, going all the way back to 2019. So for those of you that are looking to apply this a little bit further, I think you would find exploring some of the past FOMC days to be useful. Now let's dive into stage 1, which is the build-up stage. Now typically the time period for this is 6:30 a.m. Pacific, so when the markets open, leading up to, in today's case, 11 a.m. when the FOMC meeting minutes are released. Now that gives us a nice chunk of time in which we have very low volatility leading up to the actual minutes being released. More often than not, we tend to have choppy markets during this period compared to trending markets, so no real trend. Buying the dip in existing trends typically here is a little bit of a hit or miss with lower probabilities compared to, say, a typical normal morning in which trending markets, or trends rather, would be well respected. With regards to our volatility models, on the futures markets, we're typically on the scalper volatility box to begin with. This is our most aggressive model, so this gives you an idea of very little volatility to begin the day. And for stocks and ETFs, we're typically on the aggressive volatility box models. Again, the most aggressive ones we have, suggesting very little volatility. Now let's take a look to see how stage 1 looked like with today's activity. So here I have a chart of the S&P 500 futures. We're on the scalper volatility box models, and what you should notice is leading all the way from 6:30 till 11 a.m. Pacific, that's shortly after where we see on our charts here, we have price action really just chopping around sideways well inside of even the scalper volatility box models clouds. This gives you an idea that we have very little volatility in the day. The market is really just waiting. It's anticipating that volatility to spike up, and for the most part, we tend to go down, we tend to go up, we tend to go down, we tend to go up. It's a whole lot of chop, very little trend. Now we move on to stage 2, in which we have the initial FOMC reaction. Now the time period for this is that initial 30-minute chunk once the minutes are released. So that's 11 a.m. to 11:30 a.m. Pacific, and the characteristics during this period are the following. We have a dramatic increase in volatility. This is true even on something like, say, a 1-minute candle, in which the candles have incredibly large bodies, almost too large to be able to do anything with. I think for the most part, my guess is these are algorithms that are trading this initial period given the length of bodies that we see on the candles and what would be, say, a stop required for those of you looking to try and day trade this initial period. It's more stage 3 that I find where we have actionable insights, but stage 2 is very useful information. The biggest piece of information that I think we get from stage 2 is a very clear spike in one direction. Now that direction has varied over previous FOMC days. Sometimes we've seen a large spike to the downside, sometimes we've seen a large spike to the upside, which is what we had today. There's no predictability there. However, there is a very clear spike in one direction. Now with regards to our volatility models, on the futures markets, the volatility has expanded. If you remember in stage 1, we were on the scalper models. In stage 2, we're typically on either the conservative or even the doomsday conservative volatility box models, really suggesting that, hey, it's time to be much more conservative here. Price action is moving pretty fast, and it's time to adapt to the changing volatility conditions. For stocks and ETFs, we're typically on the conservative volatility box models, and in many cases, you'll find a series of stocks in which price action breaks even outside of those. This is our clue that, hey, volatility is starting to pick up dramatically, which markets to focus in on, and which markets do we ignore if they've already broken outside of their respective volatility box models. Let's take a look at how stage 2 looked like today. So here's all 4 of the major index markets. If we take a look to see which model each market is on, the S&P on its doomsday conservative model, we can see price action has gone all the way up to our cyan lines, and that's where we finally found a bit of resistance. We're chopping around sideways. We have multiple touches here of the cyan line. Same thing on the Dow, doomsday conservative models. Same thing on the NASDAQ, doomsday conservative models. And same thing even on the small caps with the Russell futures with our doomsday conservative models. Here the Russell going even deeper into our volatility box clouds. So very clearly here we have a stark contrast between stage 1, in which we were on our scalper models, prices really just chopping around sideways leading up to FOMC, with that very first 1-minute candle, large spikes up, where we're now all of a sudden adapting to the changing volatility and we're on our doomsday conservative models. Now this takes us to stage 3, which is the fade of the initial reaction. This time period is the next 30-minute chunk in that 11 to 12 p.m. Pacific hour. So this is now 11:30 to 12 Pacific. So this is leading up to the final hour of the markets now. Some of the common characteristics of this particular stage: the volatility picks up once Powell begins speaking, and that's during this 30-minute chunk. And we can see that quite clearly with the actual fade here. We tend to reverse direction based on whatever we saw in stage 2. So in today's case, we had a move to the upside. So we see a reaction where we have a fade back down to the downside. Typically, this fade is equal to the same move that we had on the upside. So we have the equal and opposite reaction here from the markets, from the algos, whatever it is trading behind the scenes here, we have an equal and opposite reaction. Now for the days in which we've had an initial reaction to the downside, we've seen the opposite, an equal and opposite move, but this time to the upside. So in either case here, we have a fade of the initial reaction that we saw from stage 2. One more time, we see the large bodied candles continue, even on the 1-minute time frame chart. And we're typically at this point for our futures markets on the doomsday conservative volatility box models, knowing quite clearly which markets we're focusing in on and which markets we've already broken outside of our models. So those would be the higher volatility where even our models can't contain it. So that's the or breaking outside. And for the markets that are respecting the doomsday conservative models, that's our clue that, hey, these are the markets to focus in on and look for the fade in the opposite direction. Now for stocks and ETFs, same idea, conservative volatility box, sometimes even breaking outside. And here the overlap tab is quite useful in terms of finding the very best volatility candidates. If I give you an idea of what the overlap tab looked like today, leading up to FOMC, we had just a handful of stocks here. I think up to Cube was the list leading up to that 11 a.m. Pacific mark. And once we had FOMC hit, we can see just how many additional stocks triggered on our overlap tab, many of which were large names, ETFs like XLY, DocuSign, Google, Home Depot. So you had your selection if you were a stock trader in terms of picking the volatility markets here that you would look for a fade of that initial reaction. Now if we take a look at how this looked like on our charts here, this is what that fade looked like. Very clearly moved to the downside. This is the S&P, this here is the Dow, this here is the NASDAQ, and then finally we have the Russell where we had gone deeper inside of the clouds and regardless still had a fade taking us all the way down to our long entry across all 4 of these major markets. So we had the fade here of the initial reaction. The initial reaction was up in all 4 of the major indices. We then had a fade of that initial reaction once that next 30-minute chunk started and Powell began speaking. And that then takes us into finally stage 4, the aftermath. The aftermath is that 12 to 1 p.m. Pacific mark, the final hour of the markets. Now, common characteristics during this hour, or this stage rather, we have a continuation of the trend. However, it's about 50-50 with regards to if it's the trend in the direction of the initial reaction. This is from stage 2, or from the fade of the initial reaction in stage 3, which we just talked about, to the downside. More likely to trend at this point, this hour, versus chop around like we saw in stage 1. So now we're back to trending markets where you can look for things like higher highs or lower lows in terms of trying to determine which direction is this trend. The volatility contracts on a relative basis when you compare it to, say, stage 3. However, compared to something like, say, stage 1, the volatility is still much higher in stage 4 in that final hour of the day. Typically, we're not trading in this hour, as we've broken outside of most volatility models at this point, even going outside of the fades that we were looking at, where at this point we're simply observing, taking a look to see what happens with price action, and really getting a chance to sit back and observe and take a look to see how this volatility shapes up as the day closes. So let's take a look at how stage 4 looked like today. So stage 3, this is the 11 to 12 hour. So this is when the FOMC minutes actually came out. We had the reaction, we had a fade of the reaction, and then price action goes outside of our clouds. And in the final hour here, you can see volatility compared to the previous hour contracts. Price action here is respecting the doomsday conservative models, or at least chopping inside of it before finally headed out in the final few minutes of the close, compared to what we saw in the previous hour, where price action dramatically breaks outside of the models. So a stark contrast there. However, if you were to contrast this with stage 1, where we were on the scalper models, price was inside of our 2 cyan lines, then you'll notice there's a big difference here in terms of the volatility between those 2 stages. So hopefully you have an idea here of how each one of the 4 stages transpires on FOMC days. Now let's put this together with taking a look at the video from today's FOMC meeting minutes being released, so we can really step through this together and take a look at each stage as we progress through to the next stage. So here I have a recording from what volatility looked like headed into the FOMC event. You'll notice we're on the scalper Volatility Box models in all 4 of our major index markets. Now if I hit play and we come forward here, we can see the initial spike once 11 a.m. hits. Pretty dramatic spike to the upside, very quickly breaking outside of our scalper, our aggressive models. I'll spare the full details here in terms of playing this video out. It's about an hour long, but the end idea here that we're taking a look at is price action, very large 1-minute candles here. We're currently in stage 2. We're looking for that initial reaction, which today was to the upside, and we're adapting to volatility as price action continues to make its move. Now, if I skip further here, we can see once price action chooses a direction, we start to chop around sideways. We calm down just a little bit here. We have a whole lot of sideways candles here with price action chopping in between. A lot of wicks, both sides. We've hit the cyan lines on the other end. And at this point, this is less than 5 minutes into the FOMC meeting minutes event. We're already on our doomsday conservative models in the S&P futures, the Dow futures, the NASDAQ futures, and the Russell futures are the last one to catch up, which the Russell, a little bit more aggressive there on the doomsday aggressive model still. So in terms of volatility there, the Russell was showing the least amount of volatility on a relative basis to the other 3 index markets. Now if I skip forward here, we still chop around sideways. We have the initial reaction. We're still at 11:15 here, so we have 15 more minutes until stage 3. So let me skip forward to that point here. So price action headed up one more time, and as we head closer and closer to 11:30, once Powell starts speaking, you'll notice the sharp reaction, the fade to the downside here. So we're starting to see that reaction take place, and we have larger and larger candles starting to print to the downside. And then we have the one large candle which takes place here once 11:30 hits. Powell begins speaking. We see this sharp move to the downside here. So let's continue watching this. I'll skip this forward just a tad. Now we can see we touched the downsides volatility box lines on the doomsday conservative models. We have the fade set up there on the 1 minute time frame if we do see the edge signal in time. we have the immediate reaction away, a bounce in the long side here off of all 4 of the major futures markets. And then finally, price action reverses into the final close of this hour, and we have a puke down breaking outside of even the lower doomsday conservative clouds, really telling us that now volatility has picked up on both sides, short and long, in all 4 of the major index markets. So hopefully this video walkthrough helps to piece together the 4 different stages we talked about. You can see how the candles shaped as price action actually moves forward through that FOMC hour, and hopefully gives you a repeatable way to try and trade future FOMC events, knowing that we have these 4 stages. One more time to recap. We have stage 1, which is the build-up phase. Here we have very little volatility, typically on our scalper models on the futures markets, aggressive models on the stock markets. We're just chopping around sideways, almost feels like the calm before a storm. Then we move on to stage 2. Once 11 a.m. the FOMC meeting minutes are released, we have the initial reaction. Here we have very large candles, typically just need to sit back, wait, and observe to get a sense of what direction price action is moving in, and start to wait for price action to calm down and look for stage 3, a fade of that initial reaction. Now once stage 3 passes, we're then taken to stage 4, which is the aftermath. Here typically just observing. Most likely price action is broken outside of many of our volatility models, and at this point you may even look at something like, say, the stock scanner, looking to try and pick and choose the markets where volatility is still being respected. We have an overlap of, say, our hourly and daily models, and use that as a sense of taking advantage and profiting from this volatility. Alright, hope this video was helpful. I'll leave links to the FOMC previous trade reports in the description box below, along with a link for each one of the 2 volatility boxes, futures and stocks, in case you are interested. Take care everyone, good luck trading, and I'll see you in the next update.